As already mentioned, my name is Peter Hafez, and I'm the head of quantitative research at RavenPack. Just a little bit on RavenPack before I jump into the presentation. We're basically a big data company focusing on turning unstructured data into a structured data feed, or what we call analytics. We process news sources, or what I'm going to talk about today is built on top of news data, primarily coming from Dow Jones. So we take Dow Jones content in through a direct feed, and we turn unstructured data into this structured data set that we sell to our clients. And we add about, or less than 200 milliseconds of latency. So before you blink an eye, we have analyzed the text and send it off to our clients that are able to have an automated process at their end as well, and basically being able to put in a trade before any humans would have any chance of reading that same content. We not only look at Dow Jones content, we also look across more than, or we basically get in something like 50 or 60,000 different sources from the web as well. Both, can you say, from professional media over to social media. We haven't currently productized Twitter, but we do include social media content, but mostly coming from reputable blogs. Twitter is somewhat of a different animal to more traditional news, for those that ask why we haven't productized Twitter yet. But our clients have a strong need for, can you say, high precision rates, and Twitter is a very noisy source. So we have kind of kept that in the R&D for now, until we believe that we can address that in the way that is how RavenPack wants to have the products in terms of precision and recall. So if we jump into the presentation, I'll first provide a quick overview of what a news analytics dataset looks like. So I'm going to focus on some of the key attributes that are important when you start working with this type of data. I'll also present a little bit on our event taxonomy, which is one of our key selling points, and which we believe are, of course, very important if you want to take full advantage of this type of data. And the rest of the presentation is basically jumping off from our analytics and our taxonomy, and I'm going to show how we have used that, or the different dimensions, to build a set of thematic alphas that we in the end use to create a thematic portfolio. And as part of that portfolio construction process, we focus on 4 steps. So first we create our indicators. So we take all of the granular data that is produced from the raw news and turn that into a trend indicator, so capturing what is there a positive and negative sentiment on earnings for IBM right now, or is there an M&A theme or an insider trading theme? So we basically, I'll talk about how we create those indicators. I then move on to using those indicators to create alpha strategies. And I'll end up with multiple alpha strategies at the same time, running in parallel. And the third step is bringing those different alpha strategies together into a portfolio. And I'll explain a little bit later why we have taken this approach, that is creating multiple alphas and then combining them in the end, because it gives you some benefits in terms, especially within turnover, bringing down turnover. But I'll talk more about that. And then finally, we also apply some algorithms on top that addresses specifically, can you say, the turnover of the final strategy. You can say that the final step there falls outside of the scope of the news analytics process itself, and it's more related to the implementation of these type of strategies. So this is, and I hope everybody can see this, it's perhaps a little small, but this is basically what a news analytics data set looks like, or at least when highlighting some of the key attributes. We have probably something more like 40 different columns of information. Each, but these ones are the most important ones, as I mentioned. Each row is basically represents a detection of an entity covered by RavenPack. Currently, we cover more than 200,000 types of entities, spanning anything from companies to places, organizations, currencies, commodities, and people as well. And all of these will have a unique RavenPack ID such that you can map those particular entities into the instruments that you're interested in trading, if that is your end goal. This particular example is focusing on our equities package. So all of these, all the entities that we detect in these records are companies. So for each story that we see coming through and we detect an entity, we will create a record. So basically one row in this table. So if we detect IBM buying some other company, we are able to detect IBM as well as the other company, of course. Or we could take an example. When Google acquired Motorola, we were able to detect both Google and Motorola in that story. And we would produce two records. They would be linked by the story ID, but you would have two separate records for each of those, and we would provide you with the different attributes for both companies that would be company specific. So, but first of all, the first key attribute is obviously the entity recognition part. And obviously that's important in order for you to link it back to whatever you want to trade. The second part is relevance. So you can have multiple entities mentioned in the same story, but the story is not going to be equally relevant to all of them. So for instance, places are mentioned a lot in news. So you could have a story talking about Apple, the company based out of San Francisco. It's not really going to be about San Francisco as such. It's more about Apple. And and relevance is really the way to link the whether a particular entity is involved, for instance, in an event, and also how deeply it's involved in that particular event, or whether it's just a mention. So it's very good for noise filtering. And it's especially important for global macro, because as I mentioned, places are mentioned a lot. But it's also important for companies. We typically see that you'll get stronger analytics coming out or stronger signals coming out if you focus on companies that are typically mentioned in headlines or or part of an event itself, play a key role in an event, or at least in the first paragraph of a news story. We also, on top of that, do actual event detection. And this is where we start focusing on the roles that companies or places or organizations play in a particular event, whether they're the target or whether they're just playing more of a supporting role. So for instance, for an analyst rating, where Goldman Sachs is upgrading Toyota, Toyota will have higher relevance, and they will take the role of, or they will have the event analyst ratings upgrade, for instance. Where Goldman will have lower relevance of 20 because they are not the target, and they will have an event which is called analyst ratings upgrade rater. So you can still condition your signal on whoever gave that particular analyst rating. But we cover more than 2,000 different types of events, and at the most granular level, but it maps into a taxonomy, where at the very top level we have 5 topics, and as I mentioned, at the very bottom level we have more than 2,000 different types of events. And I'll show the next slide. We'll talk a little bit more about the taxonomy, so I won't go too deep there. But what we find in our research is that when you focus on the events that rather than just news in general, positive and negative sentiment, you get stronger signals out. I tend to say that sentiment, which is also the fourth attribute, whether something is positive and negative, will tell you something about the strength of the news, and also direction. So obviously positive and negative, and to what degree. But what you don't get out of it is how quickly the information will get incorporated into prices. And their event detection capabilities are really important. And I will show you some examples of that in a second. The final key attribute in a news analytics dataset is looking at novelty. So how new and novel is this information? Is it something you have seen before? That is it a repeat, or is it a continuation of a pre-existing event or theme? So depending on what you are trying to achieve with this, you can say, okay, I want to event trade, I want to trade quickly. But I only want to make decisions based on the first time I see this event, because of course it's not going to have the same impact on prices if the second or third time that I see this particular event being covered. But in other applications, you might actually want to capture this type of dissemination effects, whether how many sources actually pick up on this event. Is a particular event getting extra steam? And that might be an indication of the importance of the news. So if you're not working in a low latency type environment, then there's also information in knowing where you are in the novelty chain. So these are the 5 key attributes. I'm happy to take questions as part of the talk, by the way. So please just raise your hand. I don't know if there are any questions this far. Yep.
What does ESS stand for?
ESS is basically just the event sentiment score. So, and GNS is our global event novelty sentiment, or score, sorry. We have multiple techniques. We have what we call the traditional techniques, which is looking at positive and negative language. So it's more like, let's say, a dictionary type approach. We also have techniques that have been trained on human input. So we have had humans read through, or analysts read through thousands of news items, and having classified those as being either positive or negative. And when we have found a consensus amongst those analysts, that story would go into a training set. And then our algos would try and emulate how humans would look at a particular news story. And then finally we have, and this is really what ESS is about, our event sentiment score is looking at, or it's aware of our event detection capabilities. So we have had a set of analysts say, is this positive, is legal issues, plaintiff news positive or negative? And to what extent? And that will be reflected in our event sentiment score. On top of that, that will kind of form the base of a sentiment analytic. And whatever we can extract from the news itself of additional information, we will use that to augment our sentiment scoring. So for instance, if you look at an earthquake, we will detect how big an earthquake it is on the Richter scale. So our algos are aware of the Richter scale. We will also look at how many casualties there have been, and so on. Or if you look at analyst ratings, how much were you up or downgraded? Earnings, how much did you beat or miss expectations, and so on. And all of that will feed into the sentiment scoring. So this is a quick look at our event taxonomy. So we basically work in a 4 tiers framework. So at the very top level, we work with 5 different topics. And I actually tend to, in my research, to introduce a 6th topic. But we cover business, economy, politics, society, and environment. I also tend to spin out corporate news, which basically means that the news has detected companies in it. So it's company-specific sentiment. But company news can fall into both business, economy, and political news. But I want to distinguish between news that comes from a macro point of view and news that comes from, let's call it, a micro point of view. And you can basically work on any level of granularity that you want. If you wanted to work at a little bit more granular level, you could work at a group level. So we have groups that cover bankruptcies, civil unrest, credit ratings, product services, labor issues, and so on. And at the very bottom, that's where you have the more than 2,000 different types of event categories. And that's anything from analyst ratings changes, negative, positive, and so on. For instance, in our M&A category, we have something more than, I think it's more than 60 different types or 60 different event categories. So it's anything from a rumor to some regulatory entity that needs to accept or reject a particular merger or acquisition. And we're also able to distinguish the different roles, so who's the acquirer and who's the acquiree. So you can see it's a quite granular set of information that you have available. I will work today at the group level. And one of the reasons for why I do that is that, of course, as you go more and more granular, you have less and less data points available to work with. And as a quant, you'd like to be able to say something about statistical significance. And that requires perhaps that you move a little bit higher up into this taxonomy. So moving on to, can you say, a use case of this type of data? So this is kind of more the general overview of what a news analytics data set looks like, and also focusing on the event taxonomy. The rest of the presentation will be all about use cases, or more a specific use case. So as I mentioned, we have a 4-step procedure in coming up with our thematic portfolios. First, we're going to look at how we create our indicators, and then we're going to use those indicators to create a set of alpha strategies. Those alpha strategies are combined into a portfolio, so there's an optimization going on. So how much should we weight each of those alphas in our final portfolio selection process? And then finally, we'll try and see how can we implement this in more efficiently. So we look at data going back to 2007. However, we do have data going back to 2000 for those that want to backtest over slightly longer investment horizons. We focus on relatively short investment horizons on this paper, and we think that it's more relevant to look at more recent data than looking at the entire history. I will say that typically you'll see that the data is performing very strongly earlier in the cycle, so I would get even better results out had I done it back to 2000. So basically I spanned 2007 and through April this year. The indicators that I construct are cut at basically 30 minutes before market close, and I assume that I can trade at the market close prices. So I work only with daily price data. And finally, and that obviously also means that I have to ignore any intraday effects. And of course, the closer you move into the news itself, the more value you are able to get out of these type of signals. But I ignore any intraday effects here. So if we look at our indicator construction, I basically create these corporate sentiment indicators per theme at the group level, as I mentioned in our taxonomy. So I utilize quite heavily our event taxonomy that I showed before. We focus only on highly relevant news, so I take the relevance dimension of the data, and I filter for relevance of 100, which means that we have been able to detect the company playing a target role in an event. I use our event sentiment score, so ESS, and I just simply take the average sentiment score because ESS already includes some information about the potential strength of that signal. So I want to utilize that, and I do that by taking the average. But instead of taking average of everything across all news for a given company, I do it per event group. That will allow me to carry forward the information that I have and being able to say, okay, this news will be incorporated into prices perhaps in a couple of days. This news will take several weeks. I can make that distinction by bringing over and basically averaging per theme, per event group. And we also split our universe into US and European stocks, and not only into regions, but we also do it based on market capitalization. So we look at large cap versus small cap or large mid cap. So we look at the Russell. So for instance, for the US, we will distinguish between the Russell 2000 and the Russell 1000. And the reason is that you will see that news are incorporated faster into stock prices for US large cap than for US small cap. So markets tends to be more efficient, not surprisingly, for large cap stocks. But you will also see that news gets incorporated faster into stock prices for US stocks than for European stocks. So US markets tend to be more efficient than European markets. And that's why we want to make that split. So having just briefly mentioned how we create our indicators. So we basically have a daily score per company, per theme. And a company can have multiple themes going at the same time. So I can have a score for IBM and say there's been earnings news, and this is the sentiment, average sentiment within the earnings theme for IBM today. So I look over the last 24 hours. I could also have a theme going on that would be about products and services for IBM today as well. And I can also have one for analyst ratings or M&A, depending on what type of news they have. So multiple scores per company, but one score per theme per day. Right? So based on that information, we can create a set of alpha strategies per theme. And we do that taking multiple approaches. So we create a set of dollar neutral alphas, basically. And by dollar neutral, I mean we are long and short in every single alpha. But we create a long strategy where we say, let's go long either using a ranking approach or just a sentiment approach. So we go long the top 20% of stocks with the most positive sentiment within a given theme. So it could be earnings. We call that a rank alpha. And then we short the market. Or we can also go long all stocks within a given theme. So all the ones with positive sentiment. So here we are not in control of the size of the portfolio. Here we know the size. Right? We do that also on the short side. And then we take the spread as well across the long and short. So as you can imagine, already here we have a lot of alpha strategies being created. Some of them obviously will be correlated, and we'll address that in the next step. We also create a set of alpha strategies based on investment horizon. So if we focus on earnings and we look at as a theme and we look at the rank approach, we will have a earnings alpha using rank. Let's say we focus on the spread, and we will have one with a 1-day investment horizon, 2-day investment horizon, 3-day investment horizon, up to 10-day investment horizons. So we create multiple alphas within each theme and within each rank, no rank, and so on. So we end up with a large number of alphas. In this particular case, I basically show the performance of these individual alphas for, in this case, for focusing on Russell 1000 companies for the non-ranked approach. So here you have the positive alphas, here you have the negative alphas, but I've only kept the ones where we have found statistical significance. And I've only shown, can you say, the information ratios over the given investment horizon where I've also found statistical significance. So for instance, if you look for insider trading, you can see here that we have found statistical significance 10 days out. And actually, it's expanding even beyond the 10 days. But we cut our study, in this case, at 10 days. So these are the information ratios you would have achieved had you just traded based on our insider trading alpha strategy using a no rank approach, only trading positive and insider trading news. We can also look at it from a negative sentiment point of view, and you can also see that expands quite far out. So this is our negative sentiment alphas, also for insider trading. One of the key takeaways looking at this picture is that generally you see that the market response following news belonging to a particular theme moves very much with sentiment. But you also see that, and that's something I should highlight here, that all the non-red colored alphas or performance strategies, or the strategies here, the performance figures, means that prices moved with sentiment. Red means that it moves against sentiment. But in most cases, you see for negative news that the prices move with sentiment, where for positive news, you can actually see that they start moving against sentiment in some cases. Sometimes it's more of a reversal. So if you look at stock prices as a theme, that tends to be very much backwards looking. So it will be news saying stock price went up or stock price went down. Of course, you will see on day 0 that there's a strong move with sentiment, but it turns into a reversal over the following days. Right? So there's an initial overreaction, and then it reverts. And that's something which is very important and showcases the importance of looking at event themes. Because if you just look for positive and negative news, well, stock price is going up. If you look for data vendors, they will see, well, that's a positive thing, and you just trade it positively. But actually, there tends to be an overreaction. It's something that is really backwards looking, and it's overreacting, and it's actually going to turn into a reversal. And that you cannot condition on if you just take averages across everything. Right? So this showcases the importance of the thematic approach. If we look at the impact of on small cap stocks, you see that generally it moves much closer with sentiment direction. So you don't see this quick reaction quick overreaction and reversal. It's more like underreaction. It's probably because information gets disseminated slower. Less people pay attention to it, and therefore it lasts for longer, and it's more in line with sentiment. One thing which is particularly interesting here is that even just having M&A activity, being involved in M&A activity is a positive thing, stock price-wise. So you can see, even though you generally see this as negative news, actually you react positively to it price-wise. So M&A activity is a good thing for small cap, where it's not the case always for large cap stocks.
Sorry, can I just quickly ask on that M&A activity, does that distinguish between acquiring or being acquired?
Yes.
It does, okay.
It does.
So it's not just the small caps are being acquired, the large caps are doing the acquiring?
No, not in this particular case. Typically you'll see that the company acquiring has a negative sentiment, and that's what you see here. But in this case, it's actually a good thing to also acquiring companies, where it's definitely a good thing to be acquired. And my hypothesis here, the reason for this, I think, it could be an indication of you actually growing up, that you are actually now starting to be in a position where you can start acquiring other companies. And that might be, or that could be that you actually, what do you call it, you're in a space where, I'm looking for the right word here, where you basically end up with less competitors. You're maturing, and consolidation, there you go. So I think that could be something that you're seeing there on the small cap side. And I think also that showcases an example of why it's also important to distinguish between market cap when you want to evaluate and look at how markets react to this type of news. We actually see some very similar results for Europe. So there is some robustness behind it here. And if we look across what event groups are significant across size and across region, we find that you have, if you look across size, you have that 21 groups overlap across regions. So if you look at large and mid cap, you have 21 groups that become significant across both Europe and the US. And for small cap, you also have 21 groups. They may be slightly different, but generally you see some robustness across in size buckets across regions. But you also see it across all 4 groups. So you have 16 event groups or themes that are statistically significant across all 4 dimensions, so across market cap as well as across regions. And I think that's a quite strong results for robustness here.
Do you give equal importance to all these groups, or can you categorize them as well?
We haven't done anything in terms of importance yet. But of course, based on the previous slide, I showed information ratios that you would have gotten had you just traded the individual alphas. And of course, some of them had higher information ratios than others, and that could be a metric used for importance. So something like insider trading seems very important. Analyst ratings, earnings, M&A also are quite high up there. So yeah, so you can definitely evaluate it from an importance point of view. But we let our optimization algorithm take care of that in our final construction.
For the Russell 1000 on the slide, for the non-ranked one you show,
Yeah.
Majority of the alphas were negative when we are talking about the positive sentiment, the upper set.
Yeah.
So and you mentioned that it works well for the small caps as compared to the mega and large caps.
Yeah.
So do we necessarily mean that it will only work with them because majority is negative if we are following the non-ranked approach? Only in the sort of 2 or 3 cases where there is positive alpha, rest of all the cases we have negative alpha in that slide. For the mega caps, the Russell one, if you can go back to the
Yeah. This is large cap. Yeah.
Yes. So, and you said the yellow ones are the positive alpha, or they are going with the sentiment. Right?
Yes, correct.
And the first set is the positive one.
Yes.
See more of reversals rather than the going
Yeah.
with the sentiment.
Yeah.
So if we are positive, then we are wrong on that basis this.
Basically, our final portfolio makes the decision on whether to be long or short based on a rolling basis. But we require that the direction is statistically significant over a particular window. So we take more of a dynamic approach. We won't necessarily say that positive sentiment, you want to go long always. We make it depend on the investment horizon you want to trade. So you could have, let's say, just this is thought up example. So let's say if something was having let's call it a momentum effect, so it would be a buying signal based on positive sentiment for 3 days, and then it would turn into a strong reversal. Our methodology would allow that type of change or shift in the way you want to trade it based on the investment horizon that you want to trade it on.
So you mean to say, even if there is a positive sentiment, you may go short on that?
Yes, yes. As long as the reaction is statistically significant.
And insider trading, that's legitimate management purchases and stuff.
Yes, yeah. So it's the regulatory filings type. Yeah. So we have covered kind of the robustness of these themes across regions and across size. And that kind of leads us on to the portfolio construction. So just a quick reminder, as part of our alpha generation or alpha strategy generation process, we created a large number of strategies. And these, of course, could be potentially correlated, right? Because we have done multiple versions per theme. So to kind of give you an overview of how many alpha strategies we actually work with is, we have 33 themes on the corporate side. We have 10 different investment horizons. We have 3 different legs, positive leg, negative leg, and a spread. And we have rank and non-ranked. So we end up with almost 2,000 different potential alphas, right? So the problem that we now have is which alpha candidates do we select? Which ones which ones and how do we select our alpha candidates, basically? So the which, well, first of all, we want them to show statistical significance, right? And the how, we do that on a rolling basis because we want the dynamics we want to allow for a change in dynamics, right? So it could be, for instance, layoffs are considered negative generally, but let's say if you're in a positive environment, it may actually be a proactive cost-cutting measure and could be a positive thing or just neutral, right? So we want to allow for that type of dynamics in our portfolio construction process. And also you could see that how quickly information gets incorporated into prices could also change. So one of the things that we saw going through the financial crisis was that news got incorporated faster through the crisis, and then it started to slow down again as you came out of the crisis. But it could also be asymmetric, that negative news or was incorporated faster, or positive news was incorporated faster. And to allow those dynamics, we basically run our optimization on a rolling fashion. So we are focusing. So that brings us down to, we need to select on a p-value. So what should our confidence level be when selecting our alphas, and what should our window size be? And we try to test for how our selection of those two dimensions impacted our results. And of course, ideally, we want to see some robustness here. So this is when we started looking at different window sizes. So think of that we basically run a mean variance type optimization just as a simple benchmark. There could be other better ways of potentially selecting our alphas. But we start out with a simple mean variance optimization on a rolling fashion. And we looked at coming up with or measuring our covariance matrix as well as our expected returns based on a 3-month from a 3 months, looking back 3 months, or looking back up to 2 years. And these were the information ratios that we achieved doing so for US large cap and European large cap. And what we find is that you seem to find some sort of peak around 1 year in both Europe and in the US. But generally you find that the lines are relatively flat, especially on the US, on the black line here, which links to confidence levels. But generally you see the peak around 1 year. So that we selected 1 year going forward. For small cap, interestingly, you want to look back a lot more. You end up with about, it changes over time, of course, but you end up with something like 500 or something, 500-600. So still quite a large amount of alphas. But as I mentioned, it can change over time. So first, the window size. We found that for a small cap, you wanted to look back longer. So we typically get also quite, both in Europe and in the US, we found about 2 years. And I think it makes sense in that for small cap, there is a correlation between news volume and market cap. So larger companies obviously have more news about them than small cap, right? So in order to get enough data to say anything about statistical significance, you probably need to look back further, time-wise. So that's why I think it makes sense, 2 years. If we look at confidence in terms of p-values that we want to apply, we also find that, and that's, we get a similar picture for both US and Europe, large cap and small cap, that you get, and here, by the way, we have turnover. So in the previous slide, we selected based on information ratio. Here we do based on turnover. We actually see benefits in applying stronger statistical significance as it helps to reduce the turnover of our strategies. And that's quite robust across as I mentioned. So we end up selecting 1 year look-back window and a strong confidence level. So we want to be confident at a 5% level, which is quite nice as well. So knowing that, we can move on to our portfolio construction. As I quickly briefly mentioned previously, we use a simple mean variance optimization. You could obviously do more sophisticated stuff, and this is a process that we will try different things as part of our research. But we have started out just with a simple mean variance optimization. We obviously have a potential issue with collinearities because we still have a large number of alphas that are somewhat highly correlated. But as it turns out, they're not as correlated as one may think. So the rank and non-rank versions are actually not causing big problems here in terms of correlation. Where you can have it is more in terms of investment horizons. Of course, the one-day investment horizon is going to be somewhat correlated to the 2-day investment horizon, but not so correlated to the 10-day investment horizon alpha. So, but in order still to kind of address the collinearity issues, we apply a two-step procedure. So first we identify alphas with high variance inflation factors. And we basically just say, let's just include all the ones with a value less than 10, which is kind of a typical cutoff point to work with. And let's investigate further the ones above 10. Or in fact, the way that what we do is that, and this is also an area where we expect to do more research in finding better ways to potentially carry over alphas. But the way that we do it is that we just include one by one based on the ones that have a width higher than 10, but we select based on the highest information ratios, or the lowest one. So we knock out the ones with the lowest information ratios, alpha-wise, until we're able to produce a non-singular covariance matrix. So that basically helps us being able to run our mean variance optimization. And as a final step, we basically, so basically what we get out is a weight per alpha per day. And we know that within each alpha strategy, we also know the weight. In there, we basically have equal weighting with each alpha strategy. But that allows us to multiply the weight towards the alpha with the weight within the alpha, so we can collapse everything into a weight per stock. And we can collapse that also across all the alphas. So when we're done with this process, we have one weight per stock. And what's nice about that is what we found was that the stocks that we end up giving the highest weights also outperform, or the most extreme weights either also move the most price-wise. So it has a quite nice feature here. So in essence, you could think of this as being almost like a sentiment score in its own, using a market response approach. So we have just used a mean variance optimization to figure out how should we weight all of these different themes in coming up with just one score per stock. So you can say it is a sentiment indicator in its own, right? On its own. But so basic, and one of the things that we have with this internalization is, of course, that there will be some canceling out, right? So we won't have a constant exposure every day. So in order to deal with that, we just rescale all the weights such that we ensure that we have a constant gross exposure. And that will help us, it will be easier to evaluate turnover and so on in the strategy. This is basically the cumulative returns you get using our strategy, using the actual weights, so giving more weights to the ones that got high weights in our alpha, so not equally weighted. This is for Russell 1000. And the green line represents the performance you get out of trading European stocks, large and mid cap. Red line is US stocks, so Russell 1000. And the blue line is the average of the two. And I just wanted to show the average because you can actually get some, you see that there are some additional diversification benefits. These are long-short strategies, so they're dollar neutral. We have information ratios in the U.S. of about 2.2 for Europe, and 2.9 for the combined strategy.
Is this a real portfolio or is it a simulation?
This is a simulation. It's the output of what we have from the process.
How
But
do you calculate hit ratio?
hit ratio is just days with positive returns as compared to the total number of days.
Do you have any explanation why it flatlined in 2013 and 2014?
I think we don't see it for the US. It's actually very strong in the US. For Europe, we haven't looked into specifically what's driving it. So, but it's definitely something we want to look into. And it's actually, the interesting thing is that we see the same of small cap in Europe, that it's flatlined here. But it seems to be only a European thing. But it's something we want to investigate further. I want to mention here as well that this is without any transaction costs. And as you can see, turnover is relatively high. So it's around 50% on a daily basis. So you hold on average about 2 days. So it's a relatively short strategy. You can, of course, the way, and that's one of the things that we want to address as part of our optimization, is that right now we're pushing towards the investment horizon that gives you the highest information ratio. And that will give you a higher turnover strategy, because you do tend to see that, of course, the shorter investment horizon is a higher information ratio, unless you start taking into consideration transaction costs. So ideally, you want to, as part of your mean variance optimization or your optimization, want to take into consideration transaction costs, and that will start to push you towards longer investment horizons. That will, because it will bring down turnover. Right? But because we don't control for that, we will get higher turnover signals out. This is for small cap. So again, you see somewhat of, more of a flatlining thing going on. It's not as severe as for large cap, but it's a little bit more flat here, but you see it starting picking up again towards the end. You don't see it for the US. In terms of information ratios, you get quite decent information ratio, 4.4 for US, 3.2 for Europe, and 4.7 for the 50-50 portfolio. The reason why I think you get better performance out of US in small cap than Europe is that there's generally more news coverage for US stocks, and I think that's really what's driving it here, rather than it being about about efficiency or how efficient the markets are. Again, similar type of turnover, get higher hit ratios though, but similar type of turnover statistics, 50 to 60% daily turnover. So as a last bit as a last point, we have tried to experiment with ways of bringing down or reducing turnover. Of course, one way would just be to incorporate transaction costs. Another thing would be to only include, let's say if I wanted a slower portfolio, just include the alphas that have significance over longer investment horizons, right? And just exclude the 1 day, 2 day, 3 day alphas. Of course, it comes at a cost of lower information ratios, but you get the pre-cost, but you get the benefit of getting some strategies that could work over longer horizons. Right? So, but if we look at ways of potentially addressing turnover, we look at three different ways. One is to combine signals, combining different alphas that are all high turnover alphas. And that's really, if you think about it, what we have done here. We came up with 2,000 different types of alphas that may be on their own, be very high turnover. And in fact, if you look at it per alpha and you look at just on a daily basis, it's like 90% turnover, 95% turnover on a daily basis. But by combining them and saying, okay, you might be in this alpha today, but in this other alpha tomorrow, and looking for the intersection, we're actually able to bring down turnover to about 55%. And if you have other higher turnover signals, you could mix them in as well and further reduce turnover. Because of course, each individual alpha doesn't have to carry the transaction cost by itself. It just needs to be covered at portfolio level. So that's really what we're taking advantage of. That's step one. Step two is that we can start fixing the portfolio size. Right now, we're just trading all the companies that have had some news in some group that we have found to be statistically significant. We could obviously start to fix and say we only want to invest in the top or bottom of these, and basically see how that impacts turnover. And I'll show you a couple of slides, and that's where we start to fix portfolio size. And we can fix portfolio size in two ways. We can either select the top X number of companies in terms of weight, absolute weights, or we can select them in in a more clever fashion, saying let's first select all the stocks that intersected with our portfolio from yesterday, and then we top up with most extreme weights after that point, right? And that should also help us reduce turnover. And finally, we could do smart rebalancing. So I said before that we scaled all our weights to ensure a constant gross exposure. You could obviously do that linearly, and that won't change your mean variance, your optimal allocation. But you could also say, let's allow ourselves to move away from the optimal allocation, but potentially, and then give up a little bit of information ratio, but get lower turnover in return. So let's try and scale, or if you look at stocks that intersected, so I have a portfolio today, let's look at what intersected in terms of constituents from yesterday, and let's bring those weights to be aligned such that you just carry over the weight from yesterday. So there won't be any turnover in those stocks. And then you scale the rest linearly. What will that do to our portfolio? So we take those approaches, right? So if we look at the fixing portfolio size, the blue line here represents just selecting the top weights. And this is the size of the portfolio. So, and again, this is for the Russell 1000. So if we allow a portfolio size of up to 850 stocks, you get a turnover of around 53%. As we select our top weights and reduce the portfolio, actually we see turnover going up. And we end up close to or around 63-64% turnover. So decreasing our portfolio size increases turnover. If we top up with intersection stocks first, we're actually able to decrease the portfolio and keep turnover as it is. Let's try, instead of just scaling everything linearly, let's try and carry forward the weights from stocks that were in the portfolio and then see what happens. We can but we could do that based on the top selection approach or the intersection approach. If we take the, first of all, just carrying forward the weights from yesterday gives us a huge turnover reduction. So we move from about 53% to about 40%. But as we see, if we then start to reduce the size of our portfolio, we actually see that this smart, what we call the smart rebalancing, starts to kick in and produce more and more value. And why is that? Well, if you look at this version first, this actually starts to converge because the intersection, as we select top stocks, top weights, the likelihood of seeing intersection stocks decreases, and therefore these will converge. But as we focus first on intersection stocks in our portfolio, and we decrease the size of the portfolio, the intersection stocks will make up a larger and larger proportion of the final portfolio. And therefore, we will take even more benefit from bringing over weights. And that will further reduce the turnover of the strategy. And in the end, we're able to get to about 33% turnover. So we're able to add an extra day on average in holding period. But of course, it comes at a cost, right? It comes at a cost of lower pre-cost information ratios. So it goes from about 2 to 1.75. So you have to give up a little bit of pre-cost information ratio. But if we look at it after fees, and here we have just applied a relatively conservative level of fees, you can see that taking the intersection approach and the smart rebalancing, so just carrying over the weights from yesterday of the intersection, you're actually able to get the best performance out. So you do get compensated, and you get compensated by holding that or creating lower turnover portfolios.
What are your conservative fees?
Well, here we have about 5 basis points. So of course you can say it's whether it's conservative depends on who you are, I guess. If you are a Fidelity, Having to move $1 billion, probably it's not that conservative. But if you are, can you say, a higher frequency or mid-frequency hedge funds, it's pretty conservative. So, in summary, stock prices don't react uniformly to sentiment across corporate events, and therefore you can benefit from treating it thematically. That's message number one. We find strong overlap in terms of what event groups we find to be statistically significant, and we do that both across size and region, which we believe adds to the robustness of our approach. And you can combine these group level alphas to create or construct consistently profitable portfolios, both across size and across region. And finally, you can add some smart rebalancing techniques from a practical point of view to get further boosts in terms of can you say, post-transaction cost performance.